G'day everyone, welcome back to Pete's Investing. In this strategy edition, we'll be talking about the trading strategy using CCI14 with a moving average 20 exit and a CCI5 with minimum gains in both variations. First, always remember to review the Pete's channel playlists. That's where we review our indexes each week and our share price reviews each week. And that's where we store our strategy playlist videos. As always, click on the subscribe button, the notification bell, and like the video to support the channel. It's just our strategy videos that have been published, just a short list. Again, we're not offering financial advice. We're simply offering an educational video series for your benefit. We track on things to consider. We track on a daily chart. This is since we want to go and back test results during the GFC and during the COVID downturns. We also track and back test for revenue over drawdown requirements. This is helps to optimize our returns with less exposure. We include brokerage in our results for backtesting, and I transact with $8 transactions from my broker. You need to look at your broker costs and factor that into any testing you do. And lastly, our backtesting transacts with $2,000 per trade. So when we buy, we spend $2,000 each time we buy. Okay, let's get stuck into it. Get started. So first of all, I want to talk about we're backtesting these shares, and these are the revenues generated over the period since 2007, and that includes the GFC and the COVID downturns. These are the drawdown requirements, and as you can see here for these group of shares, we've generated $31,500 of revenue since that period, with a maximum drawdown of $18,400. So the profit over drawdown requirement for this program is 171%. Now, program 2 we're testing is generated similar results, but a bit less revenue and a bit less drawdown, but it's a profit over drawdown percentage of 157. So what we're trying to do is achieve a higher percentage gain of the profitability over the drawdown. Now, in this case, this program 1, this is the logic it uses, and I'll explain how that logic works going forward. So what we need to do is we look at our so this is the first program. This is the program profitability of program 1. This is program 2. So we're looking at BHP in this case. So we're only going to be talking about BHP results. So this applies mostly to the other charts as we progress. And I'll just show you the demonstration in BHP only at this point. So again, looking at program 1 profitability and program 2, you can see here these steps is where it enters the market and where it exits. So this first one, 392, the CCI14, you can see here whenever the CCI breaks above 0, such as in this case, it enters the market. Now it's broken above there, then it quickly falls back down, but then the price appreciates and it goes up. You can see there it's closed out when the CCI breaks below the 0 there. This one, first program, you can see here it enters the market there. Price has gone sideways. It keeps that same number of contracts and it closes out there. So in other words, this program has entered and exited the margin a couple of times, 1, 2, 3 times. In this case, it's doubled up and it's averaged down. In this case, it's only up and up once. So this is program 1, this is program 2. So again, it might look more advantageous to do this one, but this is actually to reap better results. Let me first explain the first program entry. We're looking at CCI14 greater than 0, as I said, and it exits when the moving average 20 crosses down. We're looking at a minimum gain of the last 100 bars of the highs and lows. So what does that mean? So let's look at this as an example. You can see here it's entered. It closed out here. And what we've done here was we've measured back about 100 bars or 100 days, and that equates to about 137 in terms of $1.37 in terms of range. So what we're looking at doing is we're looking at the range here looking at the lows, we're just drawing a trend line there, and the highs. And that equates to about $2 in range between the highs and the lows. So what we're doing then is we look at the break-even point. This blue line is the break-even point of our trades entered. If we go back to the start where we entered those first trades, you can see here in this program, entered the first trade there at 45.94. Entered another $2,000 lots of 61 shares at 32.54. Entered another lot there at 68.72. Another lot there at 112.35. Another lot there at 124 shares at 15.43. Then it closed out there. So how do we calculate the average there? We've got an average down calculation here. These are all the trades that were made at the number of shares we bought and the price that each one was bought at. So you can see there the overall average price. We've got 410 shares now, and the average price of all those 410 shares is $23.89. So what it basically means is that there, $23.89 is about $24. That's the average break-even point. And considering we want to get the minimum high-low range, which is $2, we want to go $2 above that. So $24 plus 2 is about 26, and that's that red line there. And that's where it exited there, above that profitability, minimum profitability level. So that's the minimum gain requirement above the average price. So we calculated the average price on that. So that's how we calculate this minimum gain to exit the strategy. This also uses that minimum gain requirement of the last 100 bars. The only difference between this one and the other one is we enter the other one, program 1, with CCI14, breaking greater than 0. Program 2 looks at CCI5, the moving average 14. So what that looks like in reality. Let me go back to this chart. You can see here, this is the CCI14 breaking above 0. And this looks at the CCI5, which is the black line, and the moving average 14 is the blue line. It's very similar to the one above, except it's just a bit less volatile. This one just simplifies it a bit. So this uses program 1, this uses program 2. Hence the results up here. So again, the drawdown requirements for each one. These drawdowns, if you look at program 1, for BHP, the drawdown is 51.52. That takes it from the highest profitability point to the lowest profitability point. That's about 51.22 drawn by hand. Calculated out, it calculates out to 51.52. That's also a little bit of a drawdown, but not as much as at that point there. So again, and the average down on this one, we look at the close being less than the entry price, obviously. So if the price has gone down, as in we average down here, it's lower than the entry price. This is still lower than the average price, and it's lower again, and then the price starts recovering before we break above our profitability level. This one has an average down as well, the close being less than the entry price. But we look at the CCI514 breaking above 0 again, with the minimum drop, with the minimum high-low range again added. So really the only difference between this one, this program 2 and program 1 closes out with moving average 20 crossing down when it's profitable. And program 2 closes out when the CCI5 moving average 14 is less than 0. So again, looking at the two moving average comparisons. In this case, program 1 uses when the moving average 20 breaks below 0, as it did there, closed out. This one when the CCI moving average 14 breaks below 0, so it closes out a bit earlier. So what I did then is I summarized those two program results, and this is simply showing the revenue, the buy-sell return, the average down, and the profitability over drawdown percentage. That's simply summarizing those results there. It's basically saying program 1 is yielded a better result in terms of revenue versus program 2. the average down is higher, which is not a good thing. You want a lower average down, but in terms of percentage wise, the profit over the drawdown, which is that over that, is 171%, which is a better result than 22 over 14. So even though that's a lower drawdown, there's less profitability. So the drawdown percentage rate is 157, which is a lesser result than that. And then lastly, looking at the monthly revenue, which is simply that divided by the number of months, which equates to about $180 a month on average return versus 129. So on that basis, this gives us a better overall result using program 1. So we'll be using that program to trade in our strategy moving forward. Again, don't forget to hit the subscribe button and notification bell and like the video if you liked it, and we'll cover more strategies in future. Thank you.